Time now to get some more analysis on these major issues driving the fixed income space with Stephen Nash from FIIG Securities. And good morning to you, Dr. Nash. Obviously, yesterday we saw CPI coming in well under expectations. Of course, really paints the picture for a potential rate cut next month, if not December. Of course, rates really going hand in hand with bond yields. And what impact does this have directly for bond investors?
Look, what we saw yesterday was a better than expected number, and bond yields falling as a result of that. However, when you look in the detail of the numbers, there were quite a few high-level changes to the methodology and that used by the ABS, and some of those revisions have been quite volatile over the recent past. So the number appeared very positive, but looking at it in more detail, it was less positive. However, broadly, it was better than expected and does open the door to a rate cut in November. However, I think there's more activity data that has to be monitored before a rate cut will be delivered.
I mean, the level for core inflation, obviously, as you mentioned, was well below expectations. Some of the recent inflation reads that we had been getting, I mean, yesterday's read really highlighted that some of those other higher reads that we had been receiving were quite seasonal due to adverse events, obviously, the floods, hurricanes, the likes, increased banana prices, that sort of thing. Does this, I suppose, put inflation back into a little bit more perspective, not only for the RBA, but certainly for investors who, I suppose, were looking at those underlying and headline figures and probably maybe getting ahead of themselves a little bit?
There was a bit of a concern within bond markets that inflation may be too close towards the top of the RBA's range, but now I think markets are agreed that it's well contained at this stage. Now it doesn't. Now I think the idea is that given these readings, the RBA is not going to be constrained if they need to ease. Now that's a big if. If you have a look at the speech by Battolino this week, I think it really indicated the RBA is really in no rush to ease. They're treating the data releases in a very even-handed manner, and they are seeing some positives out there. And obviously, Europe's not exactly positive right now, but outside Europe, they have mentioned that some of the data releases are probably better than they would have expected given what's going on in Europe. So I think we need some more information on global growth and also the European situation before the RBA moves.
Yeah, that's right. I mean, Battolino certainly pointing out that any cut to rates, which I mean is good news obviously for mortgage owners, homeowners, any cut to interest rates though really sends a signal though that the broader domestic economy is under a little bit of pressure. And right now, given that the ongoing strength of our mining boom and some of this improvement in, for example, retail sales, that sort of stuff that we're starting to see, as well as the improved data from the US, may suggest otherwise.
Yeah, well, just the idea of the RBA being on an easing bias is having an effect on the economy, and this is really the opposite of what was going on for the last 12 months. I mean, the RBA has been talking about putting rates up. That's had a negative influence now. This has changed towards an easing bias. So the delivery of the rate cut is a secondary issue. Expectations have already moved towards the idea that rates will be lower in the next 3 to 12 months. So that's already affecting things like auction clearance rates and having an effect on other indicators like retail sales. So in effect, part of the easing's already been delivered in terms of expectations.
What about the level of productivity out there in the marketplace, Dr. Nash? Because some would suggest that that would have to increase somewhat before the case for a rate cut really does come into full consideration by the RBA.
Look, I think some of the wage settlements have been a little bit on the high side. The RBA has been very concerned about that. The message about having a more moderate wage increase is, I think, getting through now. You get the benefit of possibly lower rates if you go for a more moderate wage increase. Something at or lower than the increase in CPI is probably what the RBA is looking for. So hopefully we'll get continued improvement in terms of wage claims, and I think that's already starting to occur. So again, we need more information on that, and that's what the RBA will be looking at pretty closely right now.
We're seeing banks lower their fixed rate mortgages independent of any RBA moves. In relation to some of the fixed rate products on the debt capital markets out there, are they offering good value at present?
Look, we've seen quite an increase in credit spreads globally, and that's affecting our market. Some of our infrastructure bonds, for example, have widened in terms of credit spreads. They're not affected by the European situation. A lot of these credits are very solid, so we're seeing the combination of very high yields in the sort of 8 to 9% range with very high credit quality, effectively insulated from what's going on in Europe. So we've got a very interesting situation here. We're seeing investors getting a bit tired of equity returns and looking to sell out of equities and rebalance into bonds, which I think is something to be expected, given that we've had quite a good rally of late and people are getting a bit tired of that volatility out there.
Absolutely. We saw some US durables data come in the US. Just run us through those figures.
The data was broadly a little bit better than expectations. We've been seeing a run of probably better than expected numbers in the US, and I think that's a very good positive. I think also we've got the FOMC next week. There's been some discussion of further quantitative easing. I think the US authorities want to keep this momentum going. They do have lower oil prices. Now they have lower mortgage rates. They really want to build on this momentum in terms of economic growth. They have been expressing concerns about unemployment. So further easing would really get behind the emerging recovery there, and I think that's what can be expected next week and may already be affecting market pricing.
Let's talk Europe now a little bit. Obviously, we are seeing a little bit of leaked news, the Reuters statement revealing some information to investors. Bottom line, though, is that we don't know the full details yet. We certainly don't know the level of leverage likely to happen. It seems that there's an impasse on the level of, I suppose, the Greek debt, how much Greece's creditors will be willing to accept their losses. Why is the haircut on Greek debt such an issue for the banks? Is it because they're the ones that are likely to lose out and have to write this off?
Exactly. Basically, they have to accept a higher level of loss. That means that that will affect their capital position. Every euro that they lose, they'll have to go and seek extra capital for. That's why the European Union at the moment are looking at this bank recapitalisation issue. It's really a package where the banks will have to accept a slightly higher level of losses, but they will get backing from the EU in terms of overall capitalisation. I think both have to go hand in hand, and that's a really positive development that's occurred over the last few weeks.
So it's more just about finding the balance now, because obviously they do have the support of the EU. It's not like they're being left in the dark here, and certainly they're the ones going to absorb the issue. It's not going to be passed on as excessively to the banks as it could be, or certainly not to consumers like we saw in the 2008 GFC with people actually losing out on their deposits from their banks and banks being forced to shut and sovereigns buying them up. So it seems to me like it's just now a bit of a tit for tat and who wins out best.
Yeah, well, I think the banks are, resisting the increased haircut because of the capital issue. They really see it very difficult capital raising environment right now with share prices as low as they are. So I think that they've got a bit of an issue with that at the moment. I can't see the banks accepting haircuts in the order of 60%. So apparently there's some deal being done at the moment, and hopefully that they'll sort that out. Maybe they will increase support for the banks if those extra haircuts are taken. But there's also the issue of precedent here. If Greece is allowed to do this, what happens with the other countries? So I think that's another issue the banks are also very concerned about. And
of course, Italy, the big problem there. If that goes under trouble, there'll be some serious problems, not just across the EU, but globally.
Yeah, there have been some extra concessions by Italy of late. Hopefully we can get more reforms there so that we can get that debt situation under control. Although Italy has had elevated levels of debt for quite a period, it's just a question of what's happening now in terms of the financing costs, because as bond yields rise, it's going to be more expensive for them to fund this debt.
Yeah, absolutely. All right, Dr. Stephen Nash, FIIG Securities, we have to leave it there. Appreciate all of your analysis and insight this morning.
Thanks very much.